stop what you're doing right now. Put down your phone. Close your other tabs. Because what I'm about to reveal about the institutional panic happening on Wall Street trading floors right now is so urgent that everything else in your life just became secondary. For the last 48 hours, something unprecedented has been happening. Brokers across Wall Street are proactively reaching out to their clients. And if you've been in this game for any length of time, you know that brokers usually only call you for two reasons. Either to sell you some fee-heavy product you don't need, or to margin call you when you're broke. They do not call you to give you free winning advice. Ever. But suddenly this week, the phones are ringing off the hook, and the script they're reading from is identical, it's coordinated, it's precise, and it's designed to terrify you. They're calling clients who have held silver through the dark years, people who bought at $20, people who held through $30, people who are now sitting on massive gains at $80. And they're telling them the party is over, you need to get out now. But they're not just telling them to take profits. That would be normal. They're going a step further. They're actively recommending that aggressive clients consider initiating short positions. They're pitching put options. They're pitching inverse ETFs. They're telling their own clients to bet against the strongest bull market in a generation. And the language they're using is designed to create maximum fear. They're not saying we expect a pullback. They're using words like meltdown. They're using phrases like structural liquidity event. They're telling grandmothers and retirees that a massive unavoidable crash is guaranteed to hit the silver market in the next 72 hours. They're painting a picture of a catastrophic flush that will wash away all the gains of 2025 in a single afternoon. Now I want you to pause for a second, step back from the fear, take a deep breath, and think like a detective. Ask yourself the most important question in finance. Who benefits? Since when do the big bullion banks care about your financial well-being? Since when do they proactively call you to help you time the exact top of a market so you can maximize your wealth? They didn't call you when silver was at $18 and tell you it was the buying opportunity of a lifetime. They were silent. In fact, they were publishing reports saying silver would go to $15. They didn't call you when it broke $50. They were silent. But now that silver is at $80 and ripping higher, now that the COMEX is being drained and the Shanghai spread is blowing out, suddenly they're your best friends. Suddenly they're deeply concerned about your downside risk exposure. Absolutely not. This is a trap. They are not calling to save you. They are calling to save themselves. They are frantically trying to manufacture sellers because they are desperate for buyers. For every seller, there must be a buyer. If they're telling everyone to sell, who is planning to buy? They are trying to create a wave of retail panic selling to provide the liquidity they need to exit their own toxic short positions. They are trapped in a burning building, and they are trying to convince you to run into the fire so they can use your body to smother the flames. Here's the reality. The big banks are likely short 4.4 billion ounces of silver, a metal that is disappearing from the vaults. Every single dollar the price goes up costs them billions in margin calls. They are bleeding out. And the only way they can stop the bleeding is to trick you into folding your hand. They need you to sell your winning lottery ticket for pennies on the dollar so they can cover their shorts before the real explosion happens. And the weapon they've chosen for this psychological operation, the boogeyman they're using to scare you out of your position, it's a technical bureaucratic event that most people have never even heard of. They're pointing to something called the BCI Rebalancing. They're holding up this rebalancing event like a loaded gun, claiming it will trigger a $6 billion dump that the market simply cannot absorb. They're telling you this is the catalyst that ends the bull run. But is it really a meltdown, or is this the most sophisticated bear trap we've seen in decades? Let's find out. To understand the lie, you first have to understand the kernel of truth they're hiding it inside. Because the BCI is real. But the narrative around it is a complete fabrication. Let me explain exactly what we're dealing with. BCI stands for Bloomberg Commodity Index. To the average person, this sounds like boring financial jargon. Just another ticker symbol scrolling across the bottom of CNBC. But to big money, to the sovereign wealth funds in Norway, the pension funds in California, the university endowments at Harvard and Yale, the BCI is not just an index, it's the Bible. It's the grandfather of all commodity investment vehicles. A massive passive algorithmic beast that manages roughly $108 billion in assets. Think about the scale of that number, $108 billion. This is money that doesn't think, it doesn't analyze charts, it doesn't watch the news, it doesn't care about supply shortages in Mexico or solar panel demand in China. It's blind capital. It simply tracks a basket of commodities, according to a strict set of rules written by mathematicians in New York. And because it's a passive robot, it follows a rigid calendar. It doesn't wake up one day and decide to sell silver because it feels bearish. It only moves when its programming tells it to move. Every year, in the first weeks of January, this $108 billion robot has to perform a maintenance check. It looks at its portfolio, which holds everything from crude oil to soybeans to coffee to gold to silver, and it adjusts the weightings. It has to make sure that the amount of money it has in each commodity matches the target weights that were decided upon for the new year. It's a purely mechanical process, automatic, unavoidable. And this is the fact, the undeniable bureaucratic fact, that the brokers are screaming about on the phone. For 2026, the governing committee of the index has decreed that silver's target weight must be cut. They've decided to lower the exposure. The target weight for silver is dropping from roughly 4.49% down to 3.94%. On the surface, this looks like a straightforward sell order. The brokers are pointing at this document and shouting, "Look, the robot is programmed to sell." The biggest whale in the commodity market is dumping its position. You have to sell before the robot does. They're framing this as a vote of no confidence in silver. They're framing it as a fundamental rejection of the metal. But that's the deception. The robot isn't selling because silver is bad. The robot is selling because silver was too good. The index has rules. It has caps. It's not allowed to let any single commodity become too dominant. And because silver performed so spectacularly well in 2025, because it outperformed almost every other asset on Earth, it grew too big for the basket. It started taking up too much space, so the rules say it must be trimmed, it must be pruned back to size. It's the penalty of success. But the brokers aren't telling you that. They're telling you a meltdown is coming. They're using this dry administrative rule change as a psychological weapon to induce panic. And to make the fear stick, they're throwing around massive dollar figures. They're whispering that because the fund is so huge, even a tiny adjustment in percentage points translates into a mountain of cash. They're saying if this massive fund starts dumping, who's going to catch the falling knife? It will crush the bid stack. It will wipe out the order book. This is the narrative they've constructed. It's built on a foundation of truth. The rebalance is real. The selling is mandatory. But the conclusion they're drawing, that this equals a crash, is a lie built on bad math. And this is where we catch them red-handed. Let me show you the real math. Because if you actually sit down and do the calculations, you realize that the brokers are playing a very sophisticated game. There's a specific mathematical error floating around social media right now. You might have seen it on Twitter or Reddit. People are saying the target is only dropping from 4.5% to 3.9%. That's a difference of 0.5%. That's tiny. It's only $600 million. Why is everyone panicking? And the brokers love this confusion because the people saying it's only $600 million are wrong, and the brokers claiming it's a meltdown are lying about the impact. Let me clear the fog of war. You cannot simply look at the target from last year and subtract the target for this year and think you've solved the puzzle. That's rookie math. That's first grade subtraction. And in the brutal world of high-frequency commodities trading, that kind of lazy thinking gets you slaughtered. The people saying it is only a 0.5% adjustment are missing the most critical variable in the entire equation. They're forgetting about price action. They're forgetting what silver actually did in 2025. Think about it. When the year started, silver was sitting quietly in the basket, taking up its assigned slice of the pie. But then the rally began. Silver didn't just go up a little bit, it exploded. It went from $30 to $40, then to $60, then to $80. It more than doubled in a single calendar year. Now imagine you have a pie chart of assets. If one slice of that pie doubles in size while the other slices like oil and corn and wheat stay relatively flat or go down, what happens? The winning slice expands. It takes over. It starts pushing everything else off the plate. By the time we hit December 2025, silver wasn't taking up 4.5% of the BCI fund anymore. It had swollen like a balloon. The effective weighting of silver in the fund had ballooned to nearly 9% of total assets under management. So when the rebalancing robot wakes up in January, it doesn't just look at the old target. It looks at the current reality. It sees that silver is currently hogging 9% of the room, but the rulebook says it's only allowed to have 3.94%. Do the math on that spread. The robot doesn't have to sell 0.5%. It has to sell the difference between 9% and 3.94%. It has to dump roughly 5% of the entire $108 billion fund. It has to amputate half of its silver position to get back in line with the rules. Let's put a dollar sign on that. Take $108 billion. Calculate 5% of that. You're looking at a sell order of roughly $5.4 billion to $6 billion. $6 billion, that is not a nothing burger. That is a Leviathan. If you convert that into paper contracts at current prices, you're talking about roughly 70 to 78 million ounces of silver that need to be sold by this index in a very short window of time. That's almost 10% of the entire annual global mining production being sold in a matter of days. This is why the brokers sound so confident on the phone. They're not lying about the volume. They have the spreadsheet right in front of them. They see this 6 billion wave coming, and they're telling you it's mathematical suicide to stand in front of this train. And if you only looked at this one number, if you only looked at the sell side of the ledger, you would agree with them. You would panic. You would sell. But this is where the trap closes. Because in financial markets, volume is not the same thing as impact. Just because someone has to sell $6 billion worth of stuff doesn't mean the price has to crash. It depends on when they sell it. And it depends on who knows they're going to sell it. And this is the secret that the big banks are hiding from you. They're pretending that this $6 billion sell order is a surprise. They're pretending that it's hitting the market right now, this week, all at once. But is it? Ask yourself a simple question. If you knew with 100% mathematical certainty that a massive whale was going to sell a huge amount of silver in January, would you wait until January to react? If you were a shark at Goldman Sachs or a hedge fund manager at Citadel and you saw the BCI announcement back in October 2025, would you sit on your hands for 3 months? Would you wait for the price to potentially drop before you exited your position? Absolutely not. In the professional trading world, waiting is synonymous with losing. The moment that report was published in October, the moment the target weight was cut to 3.94%, the smart money started moving. They started front-running the trade. This is the dirty little secret of the index game. The BCI is not a surprise party. It is the most telegraphed punch in financial history. Everyone knows it's coming. Everyone knows the size. Everyone knows the date. So the active managers, the guys who run the funds that track the index but have the freedom to trade around it, they didn't wait for this week. They spent November selling into strength. They spent December selling into the rally. They slowly, methodically offloaded that $6 billion of exposure while the price was ripping higher. They used the liquidity of the bull market to hide their exit. They were feeding the ducks while the ducks were quacking. So by the time we actually get to January 2026, by the time the brokers are calling you on the phone screaming meltdown, the vast majority of that selling pressure has already happened. It's already been absorbed. The reason silver didn't go to $100 in December, the reason it paused and consolidated around $80, was precisely because this selling was taking place in the background. The market has already eaten the $6 billion meal. It's digesting it right now. What's left for this week? What's left for the so-called crash? Only the dumb money. Only the strict passive ETFs that are legally prohibited from trading early. They must trade on their rebalance date. But these funds are tiny compared to the whole. They represent maybe $2 billion or $3 billion of the total. They're the tail of the dog, not the dog itself. And this reveals the true nature of the broker's call. If the big banks know that the smart money sold in December and they know that only the passive robots are selling today, why are they telling you to short now? Because they want you to sell the bottom. They want you to look at the selling from the passive robots, which might push the price down $1 or $2 for a few hours and mistake it for the beginning of the end. They want you to panic, dump your shares into a market that is already priced in the event. They're trying to get you to provide liquidity to the very same active managers who are now looking to buy back in. Think about the cycle. The active managers sold in December at 85. Now the passive robots sell at 75. The active managers are sitting there with cash, waiting to buy those cheap shares back from the robots and from you to ride the next leg up. The brokers are helping them close the loop. They are recruiting you to be the victim in a game of musical chairs that ended 10 minutes ago. This is why I call it a hoax. The volume is real. Yes, $6 billion was sold, but the timing is the lie. The impact is in the past, not the future. We're looking at a rearview mirror event, and while the West is obsessing over this paper shuffle, while New York traders are sweating over basis points and rebalancing dates, there's a force in the East that couldn't care less about the Bloomberg Commodity Index. There's a buyer who doesn't use algorithms. There's a buyer who uses ships. And this buyer is looking at this dip not as a panic event, but as a clearance sale. Let me tell you about the China Shield. Right now, as we speak, the Shanghai Gold Exchange, the physical hub where metal actually changes hands in China, is trading at a massive premium over the COMEX in New York. We're seeing a spread of nearly $7 an ounce. Do you understand the physics of what that means? It means that a bar of silver is worth 7 more the moment it crosses the Pacific Ocean. It's an arbitrageur's dream. It's free money. If you can buy silver in New York for $75 and sell it in Shanghai for $82, you don't just do it once, you do it 1,000,000 times. You do it until the vault is empty. Now think about what the BCI rebalancing actually does in this environment. The robot comes in and dumps $6 billion of paper onto the New York market. This temporary selling pressure pushes the COMEX price down. Let's say they manage to push it from $80 to $72. The brokers cheer, the shorts celebrate, they think they've won. But what have they actually done? They haven't destroyed demand. They've just put the metal on sale. By pushing the New York price down while the Shanghai price stays high, they've just widened the arbitrage spread from 7 to 15s. They've just turned a profitable trade into the trade of the century. They've effectively subsidized the Chinese accumulation of silver. Every single time the price dips in New York, the vacuum cleaner in the East turns on full blast. The arbitrage traders, the global banks, the commodity houses, the Chinese state-owned enterprises, they look at that $72 price tag and they scream buy. They scoop up every ounce that the BCI robot sells. They take delivery, they load it onto ships, and they send it to China. The dump that the brokers are warning you about is actually a gift to Beijing. It accelerates the drain. It speeds up the very shortage that drives the price higher in the long run. The BCI is literally transferring wealth from Western pension funds, who are forced to sell low, to the Chinese government, who's happy to buy low. And why is China buying so aggressively? Because China isn't trading for a quarterly bonus. They're trading for survival. They control 80% of global solar panel manufacturing capacity. They know that without silver, they cannot build solar panels. Without solar panels, they cannot achieve energy independence. They're looking at the same geological maps we are. They see mine supply shrinking. So when they see a rebalancing event, when they see foolish Westerners selling silver because a rulebook told them to, they don't panic. They laugh. And then they buy. This is the China shield. It's a massive, impenetrable wall of buy orders sitting just below the current price. It ensures that any dip caused by this rebalancing will be shallow and short-lived. You cannot crash a market when the biggest buyer in the world is standing there with an open checkbook praying for a discount. So if you listen to your broker, if you short the market right now, you're not betting against a bubble. You're stepping in front of a freight train called the People's Republic of China. You're betting that a paper algorithm in New York is more powerful than the industrial demand of the world's second largest economy. That is a suicide bet. The banks know this. They know the spread exists. They're probably the ones trading it. But they need you to be the liquidity on the other side. They need you to sell your physical or your ETF shares so they can cover their shorts before the inevitable snapback occurs. They're using the rebalancing narrative as a smokescreen to hide the fact that they are terrified of the East. So we've exposed the broker hoax, we've debunked the math, we've revealed the front running, and we've identified the buyer of last resort. What's the final verdict? What should you do when that phone rings? Remember the single most important statistic in this entire saga. The number that keeps risk managers at JP Morgan awake at night, sweating through their sheets. They are short 4.4 billion ounces of silver. They sold promises they cannot keep. They sold metal they do not have. And now with the price ripping through $80 and inventories disappearing, they are staring into the abyss of a default. They need a miracle. And the BCI rebalancing is the only miracle they have left. It's the only scheduled event on the calendar that guarantees a wave of selling pressure. It's their one and only chance to create a smokescreen. They're using this event to generate enough noise, enough fear, enough confusion to cover their tracks while they try to exit their positions. They're hoping that if they scream meltdown loud enough, you'll panic. They're hoping you will look at a red candle on a chart triggered by a mindless robot in New York and mistake it for the end of the world. They need you to be the liquidity. They need your shares. They need your contracts. They need your physical bars, because if you don't sell to them, you have to buy from China at $90 or $100. They're begging you for a bailout. So here is my final instruction. When that phone rings and you see the name of your brokerage firm on the caller ID, when they start reading from that script about downside protection and rebalancing risks, hang up. Do not engage. Do not debate. And certainly do not sell. Do not let them talk you out of the only asset that is effectively immune to the debt collapse of the Western world. Do not trade your sovereign wealth for their dying paper promises. You have to have the discipline to look past the next 48 hours. The rebalancing window is closing. The robot is almost done selling. The dumb money is almost done panicking. And once that selling pressure lifts, which is a matter of days, not weeks, the weight is gone. The beach ball is released. The price will not just recover, it will snap back with a violence that will shock the shorts. We're looking at a slingshot maneuver that takes us straight through 85 and opens the road to triple digits. The fundamental drivers haven't changed. The mines are still depleting. The solar panels are still being built. The dollar is still dying. The only thing that changed was a line of code in a Bloomberg Index. And that line of code is irrelevant to the laws of supply and demand. This is a game of chicken. The banks are revving their engines, flashing their lights, driving straight at you, hoping you'll flinch. But their car is made of paper, and your tank is made of silver. If you hold the line, they crash. If you hold the line, the 4.4 billion ounce short position blows up. This is not just a trade anymore. It's a transfer of wealth. The wealth of the manipulators flowing into the hands of the stubborn. Be stubborn. Be the immovable object. Do not be the victim of the Meltdown Hoax. Be the beneficiary of the rebalancing sale. If they push the price down to $75, thank them. and then buy more. Because in 6 months, when we're trading at $150, you won't remember the BCI. You'll only remember that you didn't let them steal your future. What we're witnessing right now is not just a trade, it's not just a market event, it's a fundamental shift in how the world values real assets versus paper promises. For decades, the Western financial system has operated on the assumption that paper contracts and digital entries are just as good as physical metal. They created a system where you could trade 378 paper claims for every single physical ounce of silver that actually exists. They convinced the world that this was normal, that this was efficient, that this was modern finance. But that system only works when nobody asks for delivery. It only works when everyone is content to trade paper back and forth and never actually take possession of the metal. China changed the game. The East started asking for delivery. They started draining the vaults. They started exposing the gap between what the West claims to have and what actually exists. And now we're watching the consequences unfold in real time. The BCI rebalancing is just a symptom of a much larger disease. The disease is a financial system built on promises that cannot be kept. The disease is decades of manipulation finally catching up with the manipulators. Every ounce of silver that leaves the COMEX and heads to Shanghai is another nail in the coffin of paper manipulation. Every arbitrage trade that exploits the spread between New York and Shanghai is another crack in the wall. The brokers calling you this week are not just trying to save their quarterly bonus. They're trying to delay the inevitable. They're trying to keep the illusion alive for a few more months, a few more quarters, a few more years. But the physics of supply and demand cannot be fooled forever. You can suppress a price with paper. You can manipulate sentiment with phone calls. You can scare retail investors with stories of meltdowns and crashes. But you cannot create silver out of thin air. You cannot print an ounce of metal. And when the vaults are empty, the game is over. That's what makes this moment so important. We're not just talking about making money on a trade. We're talking about being on the right side of history. We're talking about owning real assets at a time when the distinction between real and fake is about to matter more than it has in a century. The people who own physical silver, the people who own mining shares, the people who refuse to sell when the broker's called, these are the people who will preserve their wealth through what's coming. The people who sold, the people who shorted, the people who trusted the banks, they'll be the cautionary tales. They'll be the stories we tell about why you never bet against physical reality. So when you're tempted to sell, when you see a red candle and feel that fear in your stomach, remember what you're holding. You're not holding a speculation. You're not holding a gamble. You're holding thousands of years of monetary history. You're holding an element that cannot be printed, cannot be debased, cannot be created by any government or central bank. You're holding the antidote to everything that's wrong with modern finance. And they want you to give it up? For what? Because a robot in New York is rebalancing a portfolio? Because some broker read you a script about meltdowns? No, you hold, you accumulate, you wait. Because when this is over, when the dust settles, when the smoke clears, the people who held silver will be the ones writing the history books. Not the banks, not the brokers, not the algorithms. You. That's the real opportunity here. Not just financial, philosophical, historical. Don't miss it. If this opened your eyes, if this helped you see through the manipulation, do me a favor. Like this video, subscribe to the channel. Most importantly, share it with someone who's about to make a mistake. Every person who sees through the hoax is one less victim for the banks. Every person who holds is one more brick in the wall. Let's build that wall together. Financial instructions. The hoax is exposed. Now go be stubborn.